everyone, I'm the Tax Pro, and today we are doing day 6 of our 90 Days to Taxes series. In this series, I am taking new businesses and businesses that may be disorganized, and over 90 days, I am getting them ready to file taxes with confidence, claiming those deductions, claiming those credits they're eligible for, and making sure that they are filing their taxes properly. So we are on day 6, and day 6 is all about putting money into a business and taking money out of a business. How do you get paid from your business? What does that look like? What are the tax implications of those actions? And that's what day 6 is all about. Now, day 6, that topic is really dependent on how you're taxed. So instead of sitting there and having you listen to the way all of these businesses have these different activities treated, what I'm doing is I'm divvying up into sub videos for day 6. So this is the S Corporation video for day 6. If you're taxed as an S Corporation, you're in the right place. If you are not taxed as an S Corporation, go ahead and go back to the 90-day playlist and select the day 6 for the way that you're taxed. If you're unsure of how you're taxed, go ahead and go back to the 90-day playlist and click on day 1. I walk you through determining how you're taxed in that day 1 video, so that you can determine what videos you should be watching. So if you're an S Corporation, you are in the right place. Let's kind of get started. First, I want to talk about how I'm going to structure this video because I'm going to hop around a little bit and I want to make sure that you kind of understand where I'm going with this. So the first thing I'm going to do is introduce you to a concept called basis. And basis is going to be important because it's going to kind of travel with us through the majority of the video. And so basis is going to be a recurring theme that is really important, but might be kind of like this weird concept at first that I'm going to introduce. I'm going to talk about basis, then I'm going to talk about contributing money into the S Corporation. Then I'm going to talk about taking money out of the S Corporation. And finally, I'm going to talk about loans to and from an S Corporation. So let's kind of get started with basis first. Basis is extremely important because it can tell us when distributions are or are not taxable. Sometimes we get like a nice little bonus tax, so to speak, on distributions that we're not super happy about. And we determine whether or not we get that additional capital gains tax based on our basis. So basis in an S corporation, each shareholder has their own basis. So basis is calculated on a shareholder level. Basis is a calculation that we do for each shareholder with the S Corporation. It is increased by contributions into the S Corporation. It is increased by the shareholders' share of income. It is decreased by the shareholders' share of losses and by shareholder distributions. Okay? So I'm going to kind of dive into contributions now, and basis is just kind of follow us through this video. So when it comes to contributions, you can contribute to an S Corporation. Generally, we see this when you're first forming the S Corporation and you're getting that stock, and that's the initial contribution. And that contribution, you can either write a check to the business, you can transfer money from your personal account to the business account, but that contribution is going to go into equity accounts inside of the S Corporation. And that contribution doesn't live in its own, each shareholder doesn't have its own equity account that contribution goes into. It's not like a partnership, okay? It's more like a C corporation. So we put the money into the business, and then that shareholder tracks basis. So when those contributions are made, basis is increased by the amount of those contributions, okay? Contributions into an S corporation is not a taxable event. Now, we have how do you pay yourself from an S corporation? An S corporation has a special reasonable compensation requirement that a lot of people miss, and it's extremely important. It is something that the IRS is starting to focus on with their audits. It's really easy for the IRS to identify and do a red flag on companies that should be audited for not paying reasonable compensation. And it's something that I see time and time again. People have elected as an S corporation and then they don't pay reasonable comp. It is a problem, okay? It is a big problem with S corporations. Reasonable compensation means that for the work as a shareholder that I do in or on my business, I am required to be paid reasonable compensation via W-2 payroll. Okay, the S corporation is required to pay me a reasonable compensation for the work that I do in or on the business, and that compensation has to go through W-2 payroll. Now, the way that reasonable compensation is calculated is generally dependent on, we'll have business owners and we'll do reasonable compensation studies, because reasonable compensation does not have a really solid definition in the Internal Revenue Code. It's very subjective. But in general, the concept is that what would you pay somebody else to do your job? And that's really difficult for a lot of S corporation shareholders to determine. The thing is that reasonable compensation is subject to FICA taxes. And the S corporation saves you money by reducing that FICA tax. So the lower your reasonable compensation, the more tax savings you have, which is why it's so highly audited by the IRS. Now, knowing that, the goal is to have the lowest reasonable compensation that we can justify in an audit, okay? Which is where that reasonable comp study comes in, because that provides support for why we're paying shareholders a certain amount. So shareholders have to get paid through W-2 for reasonable compensation for work they're doing in or on the business. If you have an S corporation shareholder who is not working in or on the business, their sole purpose is like a cash influx into the business, they're passive, they don't have a reasonable compensation requirement because they're not working in or on the business. Okay, so then they wouldn't be receiving reasonable compensation. Reasonable compensation does nothing to our basis except it reduces the taxable income of that S corporation, and our basis is increased by income, our share of the income in the S corporation, and reduced by our share of the loss. So it essentially adjusts what our share of that income or loss is going to be. So that's how it indirectly impacts it, but it doesn't have any actual place in the calculation of basis. So that's reasonable compensation. Now, outside of reasonable compensation, S corporation shareholders are paid via shareholder distributions. And what distributions are is it is the corporation distributing the income to the shareholders. And if one shareholder gets paid in an S corporation, all the other shareholders have to take distributions. Okay? So if you do distributions to one shareholder, everybody has to take them, and it has to be based on the percentage of ownership of that particular shareholder. Okay? There's one class of stock in S corporations, which means that everybody has to receive distributions in accordance to their percentage of ownership. Distributions are not taxable unless those distributions are beyond basis. So, to reiterate, basis is contributions plus the shareholder's share of income, less the shareholder's share of loss, less the shareholder's distributions. Basis cannot go negative. So, if I have $200,000 in basis before my distributions and the S corporation distributes $280,000, I have an excess distribution of $80,000. I am going to have capital gains tax on that $80,000. Okay? Distributions themselves are not subject to income tax because we are already paying income tax on our share of the profit and loss of that S corporation. So that income has already been taxed. The only time that we pay tax on distributions generally is when it goes beyond our basis, and then we pick up capital gains tax. So that's why basis is so important in an S corporation, is because it determines whether or not our distributions are taxed. Now, S corporations can loan money to shareholders, and shareholders can loan money to S corporations. It does have an impact on the shareholder's stock if the shareholder loans money to the S corp, or on the shareholder's basis. It does have an impact on the shareholder's basis if the shareholder is loaning money to the S corporation. Okay? The shareholder can increase their basis if they loan money to the S corporation. Now, shareholders can lend money to the S corporation. S corporations can lend money to the shareholders. The deal with that is that it has to be a legitimate loan. It has to have interest associated. It has to be getting paid back. And you cannot have an S corporation loan money to a shareholder in an effort to get around basis limitations for distributions. That would be trying to cheat the system, not going to hold up in an audit. Okay? So, to go over kind of a quick summary, basis is very important in S corporations. It's really important that you know how to calculate it because it is going to tell you whether or not you're going to have an additional capital gains tax on distributions. When you are putting money into the business, you may just be, initially contributing, and that increases your basis. You don't have your own shareholder equity account sitting in the S corporation like you would in a partnership. It looks more like a C corporation, which I'll go over when we talk about chart of accounts. But you keep track of your basis, okay? And contributions increase your basis. Other things that increase your basis are your share of the income, your share of the loss is going to decrease your basis. Owners in S corporations or shareholders in S corporations get paid a couple different ways. One is through reasonable compensation. So they are paid reasonable compensation via W-2. This is a requirement of an S corporation. Very, very important that you are paying reasonable compensation. And then they are also paid via distributions. Distributions generally are not taxable unless you go beyond your basis. And then shareholders can loan money to an S corporation. S corporations can loan money to a shareholder. Hopefully that was helpful and kind of gave you some clarity on how S corporations pay owners, how owners get paid. With S corporations, if you have any questions, please let me know. If it was helpful, I would love a like and subscribe, and I will see you guys for day 7.